I don't really watch these press conferences. I don't really. To me, it's if you're a macro investor and you're trading off these things, of course you need to know this sort of stuff. But if you're investing in stocks and you're trying to look for out of favor stocks and you're putting your valuations in, none of this stuff really matters. Like, it doesn't really matter. And my view is that the Fed has done enough. My view is that deep down, the Fed probably thinks it's done enough.
Hello, a warm welcome to What's Not Priced In. I'm back from London. It's good to be back. Good to be joined with the esteemed Greg Canavan. Greg, how are you?
We're very well, thanks, Kiryll, and good to have you back in the driver's seat, mate. I was struggling for the past few weeks without you, so welcome back, mate.
Okay, well, you didn't have to be so kind, but look, we've got a little bit of a different setup, so I think we just go straight into it. And obviously, we're recording this when just November has just started, so I thought it would be nice to sort of look back on what October was, and it was pretty rough. I think so journalists were sort of quick to say that the ASX 200 entered a technical correction last month. I think the S&P 500 did too. And I think in October alone, I think the ASX 200 sort of fell about 3.6%. And I think since early February, the index is down about 8.5%. And it's actually down 9.5% since August 2021. So October wasn't great, but neither have been the last few years. So I guess the question is why? What's happening?
Yeah, good question. So, as you said, pretty rough October following a pretty rough September as well. And it goes back to, I think what we've been talking about for some time is that this bear market that effectively started in 2022 after the various global indices peaked in November of 2021 isn't necessarily over. And we had a long period throughout 2023 where stocks, they bottomed in late 2022, and the rally was underway for some time in 2023, and that was very much a momentum rally. It was built around the Nvidia story, the AI story, and the narrative around the Magnificent Seven, the seven stocks that were driving that whole what we called the bear market rally. And I remember when one of these episodes around about the peak, or maybe just nearing the peak, we said that momentum is starting to break down, and we were pointing out the fact that those tech stocks, there was divergences in the momentum and the price, and that was the peak in the market. So since that peak in July, prices have fallen quite heavily. So I thought what we could do for this episode is look at some of the top and worst performers for October, and also talk about some of the I guess the one driving force behind that weakness is really the big pickup in bond yields. And we've been speaking about bond yields on and off for the past couple of months, and I've been sticking my neck out and saying that I think bonds are a good contrarian buy here. And we've got a contrarian magazine indicator to look at this week that I didn't like the look of at all. But I think in the interest of disclosure, we should be showing
Exactly.
our viewers and listeners what that contrary indicator shows. And it's not good for my bond call. But maybe, Kira, what we could do is just have a quick look at some of the major major indices for and just sort of give viewers a bit of a sense of where we're at in this cycle, because I think what we said at the end of September, after the market had sold off quite heavily, was that the markets are ready for a bounce, but we're not near a bottom yet. And it turned out to be that way. The markets did bounce. They rallied back up to clear the oversold condition, and then the selling happened again, and we've seen that big sell-off occur in October. So with that said, it might be worth just going through a couple of these charts to let viewers know where we're at in that discussion. So here we've got the S&P 500. And as I pointed out in last week's episode, this is a clear downward trend that has developed. Now, the correct interpretation of a bear market, which is a 20% decline from the peak, obviously not in effect yet. And I think you said we're not even down 10%, so not in correction mode. But this is a clear indication of a downward trending market. And in my view, probably only a matter of time before it develops into a correction and then into a bear market. So if I just put on a short-term momentum indicator, the RSI, here at the end of October, we went into deeply oversold condition. And often when you get down to that level, that's when markets tend to put in a bounce. Now, the financial pages will put in all sorts of reasons as to why that bounce is happening, but effectively, it's a technical condition that needs to be cleared. And in the S&P 500, this is on the way to being cleared. One of the things I want to point out, it got really overbought here. This is in this rally throughout the first half of 2023, and it peaked in late July. Bear markets tend to be characterized by momentum that doesn't quite get into the overbought level. So here was quite unusual, and that was, I think, more in relation to this whole AI craze where people were piling into the tech stocks, and that produced these really overbought conditions here. But the last couple of rallies you've seen, and as I pointed out, the momentum is waning in terms of we're making lower highs and lower lows, and you're not seeing the momentum get into overbought conditions here. So I wouldn't be surprised if this rally, it might take us up to these moving averages in the same way as it did in early October, but you're not going to see, I don't think you're going to see the momentum get back into these overbought areas. And that's characteristic of more of a bearish trend. So I'll just quickly go through a couple of these other charts to show you a similar picture. You've got the momentum in RSI here, not quite at these levels yet, so it could have a few more days into it. But essentially, the Nasdaq is similar to the S&P 500, similar type of structure here. Moving averages are about to cross to the downside, so this is continues to develop into a bearish trend. Dow Jones Industrials, similar thing here. We're just rallying from oversold conditions, and once that's cleared, I think you'll see the selling return. And I just threw in the Dow Jones transports. So the industrials and transports are often looked at together. And the fact that the transports look worse than the industrials tend to reflect the production of an economy, and the transports reflect the distribution of that production through the economy. So airlines, railways, that sort of stuff. The fact that this has deteriorated more so than the industrials, in very broad terms, suggests that there could be inventory starting to build up, because the transports are suggesting that there's less need for movement of goods throughout the economy. So this is I guess, just a potential warning sign that the economy is slowing, as per the discussion we had in last week's episode, slowing more so than what many might expect. But again, this got to a very oversold level here at the end of October, and we're just bouncing from that level. Another chart that shows the deterioration in the US economy more so than the major averages. This is the iShares Russell 2000 ETF, and this reflects, I guess, it's really a small cap index, but it also reflects more so what's happening in the US economy rather than, say, the global economy, where a lot of the tech stocks are exposed to international sales as well as US sales. So this is potentially breaking down through this level of support here. It did so briefly back in June 22, rallied from that level. Also, the lows from October 2022 broke through there, rallied back up, but it's really failed to move away from that level in the same way that, say, the Nasdaq or the larger indices, the S&P 500 has, and it's turned back down and broken through that level. Now, if that's a decisive breakthrough, which it quite possibly is, that's a suggestion this bear market for US stocks is entering another phase. So that's just worth keeping an eye on. And just a couple of other charts to run through on the US side of things. This is the TIPS index. So this is what the inverse of the real interest rate. So obviously, real interest rates are still quite high in the US, which is effectively what's putting pressure on the US economy and on asset prices. And this is the long-term bond ETF, which has also been the source of lots of stress for the market in general as bond yields rise, and this is the price of the bond. So as bond yields rise, the price falls, and we're not really seeing um, any signs of a low there. We're getting a little bit of support here in the last couple of weeks, but there's no definitive signs of a low for bonds, which is going to keep pressure on the main indices. And just going on to the Aussie market, I'll zoom in there. This is the ASX 200. So it's broken down here. It's rallied back into around these moving averages, sold off quite sharply. Rallied yesterday. We're recording this at just after lunch on Thursday, the 2nd of November, and we're seeing a big rally in the market today. And again, that's just clearing that oversold condition. So I don't think this is any reason to expect a market bottom or anything like that. It's really just a technical clearing the condition. So today's move has been quite strong. We're rallying back up into potentially up into this area before I think you'll see more selling again. And just to sort of look at the different sub indices, resources have been holding up really, really well. And that really comes down to the fact that the iron ore price has been holding in, and the big iron ore miners are holding up that index as well. But on the other side of the coin, you've got the banks that are starting to feel under some pressure now. This is the ASX 200 banking index. Again, just bouncing up from oversold conditions here. And the small ordinaries, that's not a good sign for I guess the market in general. If the market is bottoming and you're going to see a turnaround in the market, you do want to see some support coming in from the small caps, and there's just no sign of that coming in as yet. And just to finish off on the Aussie market, as I said, the bond funds breaking below these support levels. So my call that bonds, I think, are a good buy. Obviously, the timing's not right there, which is fine. When you take contrarian bets, you're never going to get the timing right. And I still think that bonds at these levels are going to be a good buying opportunity, but clearly the momentum is to the downside, and it's staying in these oversold levels without so much of a bounce to even clear that. So clearly very negative sentiment towards bonds, lots of selling, and that really comes down to the concern over interest rates and over the likelihood that inflation is going to be more persistent. And while ever those discussions are being had, bonds are going to struggle in that environment.
Yeah. And I think we'll definitely get more into the bonds and the contrarian indicator and the latest news in interest rates. But I thought we'd maybe continue talking about October and then maybe discuss some of the October's best performers and obviously October's worst performance. Clearly, there's more worst performance than there have been good ones. But maybe we can start off with index sectors and stocks that have been doing well. And you did say that gold stocks have held up pretty well last month.
Yeah, well, the best performers for the month of the and I've just focused on the ASX 200 to keep it pretty tight, but the best performers have been the gold stocks, and that's an interesting point to consider because gold was selling off quite sharply, and I might just go back and show you the chart of it so you can get a sense of when this happened. And we haven't talked about the conflict in the Middle East. And it's just not something that I have any expertise in, not a geopolitical expert. But gold has obviously responded very, very well to that. I think we've spoken before about the sensitivity of gold to real interest rates. And as bond yields and real interest rates started to rise, gold sold off here quite sharply. And it looked like it was heading back considerably lower because it had consolidated in these levels, it had broke down below these levels. And when you get breakdowns like that, it suggests that upward trend is over for the time being, and there's probably more weakness ahead. But on on the around the 5th of October, gold bottomed, and it put in a good day here on the 6th of October. Now, if you remember, the Hamas, I guess, attack on Israel occurred on the 7th of October. And on that day, gold rallied strongly and moved back above this consolidation area and has done really, really well. So obviously went into an overbought condition here, and we're sort of seeing a correction unfold now, which is completely, you know, a technical correction, completely understandable given the overbought condition here. But it's interesting because gold has really defied the move in real interest
Yeah.
rates. So the question you got to ask if you're a gold investor is this an indication purely of geopolitical hedging? So, and to me, it looks that way. Gold basically turned around the day before the attack happened, and has remained pretty strong since. So that's really the fact that gold has acted as a defensive hedge against geopolitical tensions, whereas bonds haven't, have probably encouraged more funds to come into the gold market. Um, but it's interesting to sort of think, okay, is gold purely responding to geopolitical tensions, or is gold starting to see the weakness in the US economy that will result in lower real bond yields in the months ahead? And you were either still in London or on a flight back last week, Kiryll, but we in this podcast I showed Lacey Hunt's latest research and outlined in a fair bit of detail using Lacey's meticulous research that a number of indicators show that the US economy is only a matter of time away from falling into recession. And there's a couple of other charts that I've got later just to back that up. But I wonder whether gold is, as I said, purely reflecting geopolitical tensions, or whether it is starting to move ahead of potential moves in the US economy, potential change in tone from the Fed. We just saw overnight the Fed has remained on hold again, while maintaining the option or the bias that it will continue to tighten monetary policy, purely because it needs to show the market that it remains hawkish. It doesn't want to give any indication that it's ready to cut interest rates. So I'm interested to see how gold is going to fare over the next couple of weeks, especially if we see. And look, I don't think this is likely, unfortunately, especially if we see a decline in tensions in the Middle East, whether that results in another sort of leg down for gold, or whether it sort of holds above these moving averages here and stays quite strong. And just on the gold price in Aussie dollars, gold broke out to a new all-time high. Now, one of the things with Aussie dollar gold, it tends to be a leading indicator for US dollar gold. Not all the time, but the fact that this has been in this broad upward trend for so long, it broke out to new highs here, corrected back down to test that breakout level, and it's now gone on to new all-time highs. That's a really encouraging sign for gold, in my opinion, for longer term growth. So going back to your earlier point about the best performers in the gold space, in the ASX 200 for the month were Silver Lake Resources up 26.5%, admittedly coming after a horrendous couple of months, so it's bounced quite nicely. Gold Road Resources up 18.5%, which has it's a nice month and up around all-time highs. Ramelius Resources up 18%. That's had a really good couple of months. Capricorn Metals, nice little rally from recent lows, I guess, and Regis Resources, which has had another rough couple of months, so it's bouncing from those oversold levels. But it just goes to show that the other gold player here, Northern Star Resources, just goes to show that gold has been the one hedge that has been the opposite of the rest of the market for the month, and that's why you've seen mostly gold stocks do quite well. And on the other side of the coin, you've got Liontown Resources. I guess that really had to do with the corporate activity in Liontown, that's down 45% for the month. Um, Credit Corp down 35% of the month. It come out with I guess, a profit warning and an asset write down based on some debt. And Credit Corp is a debt collection company. It bought a bunch of debt from. I'm not exactly sure if they were US banks or US utilities, but they're seeing more stress and more debt repayments going delinquent in the US, which means people are just not paying it
Yeah.
anymore. Which means they just don't have the funds for it. They might have lost their jobs, and the ledger of books that they've bought are just not going to deliver the returns that they expected when they bought those. So they've had to write those down. So that's another indication that there's more stress uh, at the lower end of the US economy. Where people do get into debt problems. The stress is just starting to build, and often these stresses start at the periphery and move into the core. And while interest rates remain as high as they are, I think that movement from the periphery to the core will continue. So that was interesting. Another one here, Siona Mining, which I'm pretty sure is a lithium miner.
Yeah.
Um, Magellan Financial, really just ongoing woes of funds flowing out. That was down 27%, and IGO, which is another lithium play. Actually, you probably follow lithium more than I do, mate. What's been driving that decline in the lithium market? Is it just the lack of liquidity in the market, where um, I guess you could say investors are just getting out and the lithium price is falling? Because on the other side of the coin, there's a bit of a land grab going on
Yeah,
in Western
exactly. Yeah.
Australia for lithium too, isn't there?
Yeah. I think it's a bit of an interesting one because there are definitely some lithium stocks that were once popular getting absolutely smashed last month and pretty much this whole year. I think miners like Sayona Mining or Lake Resource. I think Lake Resources is down probably over 90% over the last 12 months. It's been totally created, but there are still some stocks that have been skyrocketing this year. And I think I've written about this, I think yesterday, like Wildcat Resources, Azure Minerals. But those ones, yeah, like you said, they've sort of been the ones that have been the focus of takeover targets. So I think investors are sort of focusing on quality assets that are probably in Australia, Western Australia, good jurisdictions that are probably going to be snapped up by billionaires or like something like Mineral Resources or SQM or Albemarle, who are sort of trying to maybe buy quality assets on the cheap right now. But there's definitely people like Liontown or IGO. I think IGO released its quarterly report a few days ago, and it did say that prices are very soft at the moment. They probably will continue to be soft for a while yet in the short term. And I think IGO sort of hinted that they now have surplus volumes in their production, and I think they sort of said that they now have to manage surplus volumes to minimize any impact to shareholders. And I think they're sort of maybe predicting that their spodumene sales will likely be lower than production. So I think
I
there's
guess it
maybe
comes back
less. Yeah,
to what we talk about. The theme of this podcast is what's priced in and what's not priced in, and often with those highly speculative sectors where a lot of capital flows in on the expectation that it's a new era. There's going to be a billion EVs on the road in a few years, and they're all going to need lithium. Um, that all gets priced in and more. So when a company comes out with a bit more of a realistic update,
yeah,
the share price just gets smashed because it wasn't what people are expecting. And when that hype has retreated from the market, and now I think, from a very superficial analysis, I think the market is just becoming more selective. So
yeah,
it's where the uh, you know the the companies that might have the land that's right for consolidation because it sits next to a bigger player's tenements, they're the ones that are in demand. But your lake resources, for example, that there must be something. There must be a low quality resource that might have just been purely hyped up, and everyone jumped on board because everyone was jumping on board without having a fundamental driver of that price.
mm,
And now we're getting to a point where interest rates are proving, quite uh, difficult for liquidity conditions at the
yeah,
smaller end, and you're starting to see that real divergence between assets with a bit of quality versus assets that might be in the middle of nowhere, might need a huge amount of capital to develop, and might not be seen to have the management teams to do the job on that. So, yeah, clearly a rough couple of months for lithium, and the prices of all these things have come back significantly
I
as
guess
well.
you could say it's been a rough maybe 12 or even more months for some of those stocks like Resource. I think it's been on a steady trajectory downwards. I think like I said, over 90% down. But it's interesting because I think even the big producers, that's sort of like the new big producer in Australia, Pilbara Minerals, it's actually now the most shorted stock on the ASX. I think about 16% of its shares of free float are actually being held short, which is quite a massive total. And I think in the top 10, there's also Core Lithium, which is sort of trying to be the new producer in, I think, Western Australia. And also, I think Sayona Mining is also in the top 10 most shorted stocks. So I think the Pilbara one is more interesting, but I think sort of suggests that the market thinks that the current valuation probably doesn't reflect the reality of where lithium prices are heading. And maybe the market thinks of just overvalued.
Absolutely. And look, from my perspective, that is just I'm a contrarian investor. Whenever something is splashed across the headlines, and even though it's been a rough time for lithium prices, there's still a lot of interest and a lot of hype around the sector. And to me, using purely those contrarian indicators, to me, it's not a buy, just because there's still too much interest, still too much hype, still too much belief in the fact that the demand side is going to go
Yeah.
for years and years and years, which it will. And I think it might have been something you wrote yesterday, that often everyone thinks about the demand
Yeah.
but doesn't consider the supply. And there's a lot of supply coming online in the years to come in the lithium space. So that's something that people should consider. I'll just point out that if people are listening and haven't signed up to the Fat Tail Daily email, it's something that we send out as a company every day. It's a new thing that we've just started this week. It's called Fat Tail Daily. There should be a link in the notes to this podcast or YouTube episode. So click on that. You can sign up for free, and you can get a daily insight that tries to offer you something that isn't popular in the market. And we try to talk about things that the rest of the market isn't. So if you haven't signed up to it, feel free to do so. It's free, and hopefully it gives you some insights each day.
So very good summary. Very good summary. Well, I think maybe now we could maybe briefly talk about the biggest stories of this week, not last month. Obviously, U.S. Fed officials unanimously voted to keep rates steady, and I think that was what's interesting is that now it's the second meeting in a row, and that's the longest intermission since March 2022. So they haven't held rates steady for two meetings since March 2022, which is quite a long time ago.
Which
And also just
suggests they've
goes
done
to
enough, and they're not gonna tighten
yeah,
anymore.
yeah.
That's my view anyway.
And I think what's interesting for me is that, yeah, investing is hard as it is, but I think nowadays people are sort of trying to get new skills. And I think people try to psychoanalyze the Fed and try to psychoanalyze the comments from Jerome Powell, and they sort of wake up early in the morning and see what he has to say and sort of try to guess what he was saying. There was an interesting comment from Citadel Securities global head of rates trading, and he said they want to maintain a hawkish facade while believing deep down that they're probably done enough. So he's got some. He's not only a great trader; he's also a great psychologist. He really knows
Well,
what deep down.
I would say that's a fair comment, but you know what? I would also say he didn't need to get up or stay up because he's probably in the US, or didn't even need to watch the
Yeah,
press conference to know that. I don't really watch these press conferences.
yeah,
I don't really. To me, it's if you're a macro investor and you're trading off these things, of course you need to know this sort of stuff. But if you're investing in stocks and you're trying to look for out of favor stocks and you're
yeah,
putting your valuations in, none of this stuff really
yeah,
matters. Like, it doesn't really matter. And my view is that the Fed has done enough. My view is that deep down, the Fed probably thinks it's done enough, but it's trying to tell the market, hey, we're still tough on inflation. Because
yeah,
I think what a lot of people don't realize is that the Fed is in many ways powerless, but also very um, powerful. So they're powerless in the way in that if the market doesn't believe them,
yeah,
they've got no real power to control interest rates. When the market believes them, it does all the tightening for them. And that's what's happened recently. The market is fine in the last probably 3 or 4 months, the market has finally understood Jay Powell's uh, determination to keep rates higher for longer. For many, many months at the start of the year, they were saying, look, economy's going to slow, things are going to turn
Mhm.
around, rates are going to cut, and they're pricing in rate cuts. When you price in rate cuts, you price in uh, easier financial
Mhm.
conditions. So Jay Powell squeezed all that out of the market now, and they've got to the point where yes, they've believed him. So he can't turn around now
Yeah.
and say, actually, the economy is slowing a little bit. There's some indications there that we're just going to go on hold now, because then the market will turn around and say they're on hold, they're going to cut soon, and
Yeah.
bang, they'll be pricing easing into the futures, the interest rate futures. So he has to have the intention that he's telling the market we will raise rates if X, Y,
Yeah.
and Z happens. And I think it's a similar thing in Australia. We've got a
Yeah.
Reserve Bank interest rate decision next week. Again, I don't think it's a huge big deal. I mean, the market is pretty much 50-50
Mhm.
on it now. I don't think the RBA should be raising rates again. I think there's it's a very blunt tool.
Yeah.
So at the moment, the RBA is inflicting quite a lot of pain on mortgage holders, um, and the that's not where the inflation is coming from. The inflation in the housing market is not coming from mortgage holders going
Mhm.
crazy, borrowing huge amounts of money, bidding the market up. The inflation in the housing market is coming from a ridiculous government policy of running a hugely uh, stimulatory immigration program, yet interest rates are high and preventing home builders from creating the supply to meet that demand. It's insane. Um, so that's the problem. That's one problem. The other problem is you've got a government on state and federal level that's pumping huge amounts of money into infrastructure
Mhm.
projects at the same time that the Reserve Bank is trying to slow the economy. So a lot of that spending is absorbing capital, it's absorbing labor resources in projects that have dubious cost benefit analysis done on them. So, one good example is the Snowy Hydro 2 project. It is blown out. It is probably going to come in at a final cost of above $20 billion.
Yeah.
dollars. So, at the moment, you've obviously got hundreds, potentially thousands of workers in and around that site trying to build a big project that won't deliver until at least maybe 2028. Um, and the productivity of that project relative to
Yeah.
the money that it's gone into it is also quite dubious. And then you can multiply that by a lot. Many of these clean energy projects have dubious economic benefits. um, Even some of the transport projects, transport is essential in a growing economy. But a lot of these project prices, they're huge, they're astronomical. Governments are competing in the market for electricians, engineers, all that sort of stuff. So wages are going up. So it's no surprise that there's tightness in the labor market. It's putting up interest rates isn't going to stop the government spending
Mhm.
money. Putting up interest rates is also going to put more money into the accounts of people that have accumulated their assets. So the people that have paid down their debt. So typically, the baby boomer generation that has seen their kids move on from school, they've paid off their mortgages, and they're in the asset accumulation phase. They're looking at bank interest rates. They're looking at bank shares that are paying now, decent amounts of interest. And when interest rates go up, banks raise their
Mhm.
interest rates, so more money goes back into the banks, and obviously their funding costs increase as well. So it's not all going to them, but there is another side of that equation for rising interest rates. It doesn't necessarily take money out of the economy. I mean, it takes money out on the margin, but there's people benefiting from that as well. That is then going into creating additional demand for goods and services. So, raising interest rates, I don't necessarily see how that is going to achieve what the RBA thinks it's going to
Mm.
achieve, which is a better inflation outcome. A better inflation outcome would be achieved by a government that has a decent amount of economic um, a sensible economic policy. And I just saw a headline today. Treasurer Chalmers is talking about the energy transition needs more government intervention, not less, in order to achieve its goals. It's just so none of this stuff's going to go away, but an RBA trying to control inflation purely by that blunt instrument is not going to do the job either. So, long-winded way of saying I don't think they should raise rates,
Yeah.
but I do think the new governor is probably under significant pressure to do it. So, yeah, who knows, mate?
Yeah.
And it
Well, I
doesn't
think
matter. At the end of the day, it doesn't matter.
it doesn't
If
matter.
you have a proper valuation process where you're looking at companies, valuing those companies, and you can buy those companies at below intrinsic value, these panics that are going to be market panics that will come about because of rising interest rates. Like a good example, we spoke well, it's probably a month or two ago now about REITs being a really good contrarian
Yeah.
opportunity. Their share prices have continued to fall, and I recently added another
Mm.
REIT into the portfolio that I run for subscribers. And just this week, I went through and updated all my valuations. I looked at the consensus forecasts. I looked at all the announcements that have come out in the last couple of months. None of these companies have been adversely affected in terms of announcing profit downgrades or anything like that. Sure, that could come. I'm not saying
Mhm.
it won't, but the market has purely derated those companies on the prospect of higher bond yields and higher interest rates. And
Mm.
if you put into your model a through the cycle interest rate, these companies are very cheap. I'm not talking about putting in a really low interest rate to get a higher valuation. I'm just talking about, so I guess the upshot of this conversation is that many interest rate sensitive stocks have been oversold to levels that I think are good long term value here. If you think inflation is going to stay high and bond yields are going to go even lower from here, or sorry, higher from here, then maybe that's not the cause. The timing's wrong, but I think you're seeing a lot of good value in the market because of that very background.
Yeah. And I think of all the institutions, I think the IMF sort of backed up what you were saying in that it sort of noted that the job of the Reserve Bank is going to be made harder by decisions from Commonwealth and state governments if they continue to sort of make big expenditures. But the IMF did sort of come out, I think, at the end of October with a annual report on Australia, and it did sort of try to butt in and say that it does feel in its expert judgment that the Reserve Bank should raise interest rates maybe at least once. And they did say that if the Commonwealth government or state governments combine to sort of spend on big projects, the Reserve Bank may actually have to raise rates even further than that. So, what do you make of that? Or do you
Well, it
think
makes
none
no
of this
sense.
matters? Yeah,
It's just dumb. Like
yeah,
raising interest rates more to stop a sector that has no sensitivity to rising
yeah,
interest rates. It's dumb. Like I just
yeah.
and I'm not sure. I guess people still listen to the IMF. I used to read the IMF many years ago when I was young and first starting because I thought they were a prestigious organization. But I honestly don't even read that. Don't even listen to that. And I don't think anyone should, to be honest.
that's the one takeaway. Well, I think what you were sort of saying that raising interest rates might not actually do what the Reserve Bank thinks it does. The ABS released its latest living costs index, I think, yeah, a few days ago, and it did say that despite interest rates being held steady by the Reserve Bank for I think a few months now, mortgage interest charges had still risen about 9.3%. So the ABS specifically said that even though interest rates haven't risen, people are still paying a lot more for their mortgages, and that's because things are rolling over, and so they
Yeah, those low fixed rates are then
yeah,
rolling off
exactly,
into the higher variable rate, and that's going to continue to happen. I think we saw a big chunk of that occur in the September quarter,
yep,
so that's probably moved through the starting to move through the system now. People would be starting to get their higher bills. So there is, there's significant pain being felt. I've got a mortgage. I've got two kids in
Yeah.
school. And maybe I've got a bias to this view because I'm, particularly impacted by it. But I can tell you, I'm not a source of inflation in the economy.
You're not buying anything.
No, I'm a source of deflation in the
Yeah.
economy, if anything. So, um, yeah, and there is I guess a risk of becoming anecdotal about
Mm.
your view of the world, but uh, there is a logic to it as well, and that
Yeah.
logic is that if you have a decent mortgage, you've got a couple of kids in school, you don't have any disposable income. So if you don't have any disposable income, you can't really spend. You can't really spend overspend. And one other comment I would make, just as an aside, it feels like, and this is one of the, I guess, problems with inflation. It feels like everyone thinks they have pricing power now, and you can just, everywhere you go, people are just putting up prices because people are putting up prices.
Mm.
And my concern is that if you don't get that uh, wash through in terms of, if the labor market doesn't stay strong, the economy is going to hit a wall at some point because everyone's putting up prices and
Mm.
everyone's paying those prices. But if we don't get that follow through of um, maintaining strong
Mm.
employment pressure, employment growth, then the economy is not going to be able to handle that. Right? It's going to get to a point where people are just like, well, I can't, I can't,
Yeah.
I can't do that. So that's just something to keep in mind as well.
So you haven't been splurging on anything?
No, apart from my kids, she broke a tennis racket the other
Yeah.
day, so that's not a splurge. That's an annoyance. Like,
That's a
thanks.
necessary
Don't
cost.
crack your bloody tennis racket, kid. But anyway,
Well, I've been there. I've broken a few tennis rackets. I'm not saying I'm proud of it. I'm not Nadal, but I've been there. And my dad
yeah,
had to buy it as well, and he wasn't too happy. Uh,
tennis is a frustrating sport.
yeah, exactly. Well, I think actually I did see something that maybe I thought I would get your take on, and whether you think this has any significance or not. But there was a Bank of America analyst who sort of pointed out that in the coming weeks until the end of the year, the U.S. government is going to issue about 500 billion worth of bonds, and he was sort of asking, buyers who are sort of already drowning in U.S. government bonds, will they demand higher and higher yields to soak up this supply? And will that sort of percolate down to continued higher bond yields down the track? Do you think this matters at all? Is this something not being priced in by the market?
Uh, I don't think so. To me, bond yields, and don't forget that the Fed has continued to run its quantitative tightening policy, so it is also throwing additional supply into the market. Um, but at the end of the day, the bond, the say the 10-year bond yield is responding to ongoing strong nominal economic growth in the US, and you could argue that it is actually priced better than what it, sorry,
Mm.
the bond yield is lower than what it should be given the really strong nominal growth you've seen in the US over the past year or so. Um, so yeah, supply is a part of the mix, but I don't think at the end of the day, economic purchases will respond to um, economic data rather
Mm.
than supply, especially for a big economy like the US. I don't. I know there's a lot of negativity around the amount of supply and the amount of spending, and I get it, but I don't think that's an overall determinant of where bond yields are. Shorter term, sure, it can affect sentiment and all that sort of stuff, but fundamentally, I don't think it drives
Mm.
where the bond yield will be. That's driven by factors like economic growth, which
Mm.
is why if we do see a slowdown in the US economy, which I think we will, going into the end of this year, bond yield should come down.
Yeah. And with the Tracy Lace, the Hoisington management in the episode that you had last week, did he sort of place a timeline when he thinks the US economy is going to slow down dramatically?
No, not specifically. I think it was more just these all these factors in history have,
Yeah.
when they have occurred, the US has been in recession. So the implication was that it's not too far away. And I might just show a couple of charts to continue on,
Mhm.
or just to reiterate those points that Lacey made. Um, so, well, I probably don't really need to discuss this too much, but I noticed this. This is, do you remember the bank term funding program that kicked off when Silicon Valley Bank
Yeah.
collapsed
That
in?
feels like 2 years ago almost.
Yeah, it was only back in March, right?
Yeah.
So this was the bank term funding program that kicked off when that happened, and as you can see, it is still quite. It's maintained at a high level for the past 6 months or so, which indicates there's still a decent level of demand. I think the
Mhm.
outstanding balance is about 108 billion. So there's still a decent demand for these emergency or lending that no other private sector lender is going to do is going to make. And to be clear, this is not free money from the Fed. This is lending at high rates of interest
Yeah.
in order to keep these banks afloat. So that was an interesting take. But the main thing I wanted to point out was that, and Lacey pointed this out in his essay last week, is that bank credit in the US has
Mhm.
dipped into negative territory. Now, in the past 20 years, that's only happened in the aftermath of the GFC. So this, to me, this is a sign that the money flowing through the US economy, it is almost all deficit spending. The
Mhm.
private sector is not creating debt anymore through credit creation. So that's a big indicator that the US economy has slowed very sharply, gone from these strong rates of credit creation down into negative. And just on the same token as that, this is the balance sheet of the Federal Reserve, and that is in negative territory and
Yeah.
going down as well. Again, that very rarely happens. It happened in 2020 as the Fed was trying to tighten. Um, and many people say that the US economy was looking like it could have going into recessionary conditions before COVID hit. So,
Mhm.
and as you might remember, I think it was in 2018, the Fed had to turn pretty quickly and say, look, we're abandoning this normalization of interest rate policy because it's having a nasty effect. And that's why that turned that around
Mhm.
before COVID even hit. Um, Dipped down a little bit there, which didn't cause a recession, but didn't even dip in 2008. And to be fair, that was before the Fed become hugely involved in trying to prop the economy up. It all happened after that, but this is a pretty steep fall. That combined with the private sector not creating credit is just a bit of an indication that there are problems coming to the US economy. So just before, while I'm on this screen, Kiryll, let's just go through a couple of other charts that I've got here.
Mhm.
So
Yep.
this is the death knell to my bullish bond call. This is Barron's saying time to buy bonds. So thanks, Barron's. Um,
It's
I
pretty
might just have,
definitive. No
yeah, it is.
qualifications.
And look, every now and then these magazine covers are right. So hopefully they've got this one right. And out of all of them, I would say Barron's is probably the
Ah,
most
yes, of course.
esteemed in terms of its financial journalism, its reporting. Um, so let's hope Barron's has got this one right. But this did, when I first saw this, I think I can't remember where I first saw it. When I did first saw it, it gave me a little bit of a like a kick in the guts. I thought, yeah, well, there goes my bullish bond buy, because I have been adding bonds to my superannuation portfolio, for example. So I just resigned myself to being wrong on that for another good couple of months. Um, so moving on, I got a couple of sentiment indicators. So this goes back to what we were talking about earlier with the Aussie market and the US market. We're at a stage where we're bouncing now, but not necessarily at a low. Fear and greed
Mhm.
index, which I often look at, it's just at the fear level, which is nothing telling us that it's at an extreme low. and this is a combined sentiment index for, I think this is called the American Association of Investors, something. I can't remember
Hmm.
what the other I stands for, plus the US Investors Intelligence Survey. So this is a combined survey, bulls minus the bears. Obviously rallied quite high into this July market high. It's come back a little bit since then, but it's nowhere near those lows that we saw in 2022. So, from a sentiment perspective, we're not at that washout
Hmm.
slash capitulation low level, which I think is important to consider when you're looking at short term lows versus longer term lows. And to just reiterate those couple of things um, I look at some of these internals in
Hmm.
the Aussie market. So we've seen a pickup. This is the RSI indicator. So stocks in oversold levels. This has
Hmm.
picked up quite high. So this is when you get to these levels, it suggests you're going to get at least a short-term bounce, and
Hmm.
that's what we're seeing at the moment. But we're not at capitulation levels that we saw back in June 2022, and I guess to a lesser extent, um, September 2022. Uh, so that is indicative of short-term lows, but not necessarily long-term lows. And then I combine that with things like um, the amount of or the number of ASX 200 stocks that are within 20% of their 52-week high.
Hmm.
So that is starting to come down. So roughly 50% of stocks are in what I would call a definition of a bull market and 50% in a definition of a bear market, which means they're more than 20% from their recent highs. At these lows last year, which is June of 2022 and September 2022, um, you had nearly 75% of stocks were in bear market. So we're sort of getting there,
Hmm.
and we might see this bounce up in the next couple of weeks as the market clears that oversold condition, but we're not at a capitulation level. And just the other one I wanted to show you is the Aussie VIX index, or the VIX for the S&P, the ASX 200. It did spike up there to a multi-month high, but we're certainly not again at those sort of panic levels that we saw back in
Hmm.
June 2022 or even September 2022 when the market put in
Yeah.
a more lasting low. So yeah, just a couple of things to keep in mind to suggest that this is a bounce, not necessarily a long term bottom.
Hmm.
But in saying that, there's always plenty of stocks that are not following what the index is doing. And as I said, I've been buying some smashed up REITs and things like that. Um, not with the expectation that they're going to bottom and turn around next
Hmm.
month, but I think there's a lot of stocks out there that are trading well below intrinsic value, and their yields are quite attractive as well. So you might
Hmm.
not necessarily get the capital gain in the short term, but while you're waiting for the bear market to play out, you're going to get a decent income stream in the meantime. So that's my short term strategy. Of course, holding gold stocks and energy stocks provide a decent hedge, and when the other stocks do perform, when they're sort of bouncing from their oversold conditions, gold might sell off. So having that combination of stocks provides
Hmm.
um, a lot more stability to the portfolio, which I find comforting.
Nice. And I think before we wrap up, you sort of mentioned potential panic, and you mentioned before also that the market is 50-50 on whether the Reserve Bank is going to raise rates. If it does raise rates next week, will the market panic, or should it panic?
Don't think it'll panic. I think it'll adjust.
Hmm.
There'll be an adjustment lower. Maybe bond yields will pick up again. But I think often uh, it's interesting to watch what the longer term bond yield does, because if the market says, "Hang on, you are raising rates too much," you might actually see a rally in long term bond yields because the market says this is actually going to slow the economy. This is
Yeah.
um, you know, this is going to hurt. This is starting to, get to a point where it's hurting. If that does happen, you could see the market fall. I wouldn't say necessarily say significantly because we're at 50-50. So I think the market is in many ways effectively half expecting a rate
Yeah.
rise. but it's certainly not going to be bullish, Kiryll. I'll tell you that.
Well, whether or not it will be bullish or not, we'll be here to report it and make commentary. So, Greg, it was nice to be back, and look forward to next week.
Good to see you, Kiryll, and thanks for getting back in the hosting chair, mate. Appreciate it.
That's all right.
And thanks for listening, everyone. We'll see you again next week.